Let's connect with Manish Sonthalia, Vice President, Fund Manager, PMS with Motilal Oswal AMC. Manish, morning. Thank you for joining us. Manish, as of now, global liquidity and reform push has done the trick for us. But do you think it's a matter of time markets will be focusing on global macro, global earnings and local numbers?
Yeah, I mean, that's always there at the back of your mind, but I think the markets will be more focused on what's happening domestically, because on an overall basis, things in the global front are more or less stable. So, maybe we would be range bound between 5600, 5900, and markets would be keenly watching what the numbers are for Q2, how bad the situation is, because in any case, there is hope that GDP would be slightly better than what we have seen so far in the second half of this year. So everything hinges on that.
So what are your expectations? If I look at the Bloomberg consensus, the general consensus is that Sensex companies minus oil will grow in the range of about 12 to 15%. So 12% seems to be the base, 15% seems to be the upside cap. Do you think Q2 numbers will be above 15%?
No way. I mean, it would be anywhere between 10 to 12%, and if the numbers are between 10 to 12%, I think markets would have no reason to get negatively surprised. So if 15% sort of an earnings growth comes, ex oil, which includes ONGC, which would be a laggard this quarter, I mean, markets will be very positively surprised, I would think. So I think broad consensus are between 10 to 12%, and if that comes, markets should be fine.
Manish, which are some of the names you have sold in this recent rally, and which are some of the large cap names you are planning not to sell regardless of valuations?
Yeah, I mean, we have trimmed some exposure in two-wheeler names, so that's the trade that we have done of late. We have really not decided on what to buy at the moment, but we are working on some names, and that's how we are positioned. I think within the large caps we have trimmed some exposure in Hero Honda, because we have seen that volume numbers are slightly tepid. Bajaj is gaining ground at the expense of Hero as far as the Splendor is concerned. And that gives us some reason to actually trim some exposure in Hero Honda.
Manish, what about IT? Is it time to go underweight?
No, I don't think so. I mean, there is some expectation that Infosys might not disappoint so much on the guidance this quarter. But if you look at the numbers on a YOY basis, I think 27-28% sort of a top line growth as far as the IT pack as a whole is concerned should be seen. You should be looking at 30% plus on a YY, the large cap IT names. But specifically speaking of quarter on quarter numbers, I think margins should hold out, net profit margins at around 25%. But quarter revenue growth 2.5 to 4%. Net profit growth should be more or less flat as compared to the previous quarter. There is no negative surprise as such. And if Infosys delivers positively on the guidance, then I think you could see some action in the IT names, post Infosys numbers.
Manish, the reason why I asked this question is because I know you have exposure to Max India. Now, most of the companies which have exposure or ownership in insurance business, they have appreciated on hopes that FDI in insurance will go up from 26% to 49%. Do you think it's time to get out of some of these insurance names now?
No, not at all. I mean, look at it this way. Life insurance companies typically require 10 years to break even. You have all these established names having spent 10 years building their businesses. We have seen in the last 1.5 years, new business premiums actually come down significantly post the ULIP era. And as India is an emerging market, and in an emerging market you see that insurance business, insurance premium should at the least be growing at 10 to 15%. There is not so much of concern on the solvency, because solvency ratio is 1.5% prescribed. most of these established names have solvency ratio in excess of 1.92 times. That's not. But if you are going to grow your business and if growth comes back in a big way, which it would, then you'll require additional capital. So therein where the FDI in insurance would come in handy for most of these players. You can't really grow your business very aggressively if you don't have capital buffer, because there is front loading of expenses and you require capital to grow your business. So I think most of these businesses, life insurance businesses are mature. They are quite profitable. If there is some tweaking of taxation rates for insurance companies, the budget, that would be icing on the cake. But I think valuations are far too cheap if you compare the valuations of insurance companies vis-a-vis emerging market insurance companies, etc. So Max India is just one of those names. You're getting the company at 5,000 crores. The base case valuation for the insurance business should be closer to 9,000, 10,000 crores. You take 70% stake. The hospital business is coming for free, and they have divested their BOPP business. So all in all, a very good name to own if you are an investor for the long term.
Manish, we've chatted about IT as well as autos. What about, what about this earnings season? What do you feel is going to outperform as well as underperform this earnings?
No, I mean the outperformers will be 4 sectors. It would be banking, more so the private sector names. The usual 20% sort of a growth in net profits is what you're going to see. You'll see outperformance from pharma or healthcare as a whole. You'll see outperformance from consumer staples, the usual, and you'll see outperformance from IT if you look at it from a YOY basis. The laggards would be the usual ones of energy, utilities, real estate, metals, because you have seen dip in realization and volumes. So I mean it will be a highly polarized environment sectorally, and the ones that are doing well till now are the sectors which are going to report decent numbers. But what about looking ahead as to how things are going to shape up is what would matter.
Manish, last time you told me that you were looking at trimming your exposure to ITC. Are you still looking at selling more ITC at 277?
So we have actually trimmed some exposure to ITC, but the balance exposure that we have, we intend to maintain that. At least for the time being, unless and until valuations go totally out of whack. It's a quality company, no doubt, but there are regulatory concerns, and that is the main reason why we had trimmed some exposure in ITC. But the balance exposure that we have, we continue to maintain that for the moment.
Manish, if you are reducing your exposure to Hero Honda, which is indirectly a consumer play, if you are trimming your exposure to ITC, which again represents the consumer demand, are you negative on consumers, A? And if you're not negative on consumers, which are the consumer names you are betting on?
No, I mean we are not negative on consumer per se. We are just looking at better opportunities vis-a-vis the valuation at which other stocks are available, and where you could be looking at similar growth dynamics as far as the existing names in the portfolio are concerned. But at the same time, scope of returns are higher than the exposure that we are trimming. So it's just a trade-off between that. It's nothing that we are negative on consumers. In fact, we are highly positive on consumer space for the next 2, 3, 5 years. So we're looking at names within that space only. It would be stable franchise businesses. Unfortunately, I can't disclose the names at this given point in time, but suffice it to say, it would be relatively structural, not a cyclical, good enough name with decent growth opportunities going forward.
Manish, what about cement? Can we expect the sector to continue to outperform and earnings as well back the stock moves that we've seen in the last few sessions?
Sure. I mean, cement is now beginning its upturn. You're looking at elections coming in 2014. All this while when supply was in excess of demand, you have the price volume discipline that was maintained by players. So in spite of lower utilization of 60-70%, you had the profitability not get hampered. That was the ploy by these cement players. And now actually you're going to see some volume pick up. Capacity utilization should move north of 80%, and an upcycle valuation being available to most of the cement companies, and entry barriers in this space have just increased, with land not being available and EV per ton cost having gone north of $150 per ton, and the gestation period for a greenfield project in excess of 6-7 years. So I think cement is just entering a sweet spot. Your second quarter numbers are going to be quite supportive. In fact, you're going to see 80 to 90% growth in net profits. I think cement is a good name to look at.